Hi, I'm John. Today we're going to talk about financing a business acquisition using bank financing. The first thing you need to realize is that all banks are going to base their decisions primarily off of the federal tax returns of the seller. The second thing you need to know is that banks that claim they do commercial lending tend to do commercial real estate lending and not cash flow lending. The reason for that is because if you do commercial real estate lending and something goes south, the banker can go and sit in his collateral and think. If you have a cash flow lender, or what they call a C&I lender, and the loan goes south, that lender needs to hold on to his shirt because their collateral just went out the door when the loan went south. Banks tend to mitigate this risk by using the SBA. The SBA basically provides a guarantee to the bank that they'll cover a percentage of the losses. That guarantee is to the bank and not to you, the borrower. The benefit to you, the borrower, is that you get the loan approved and you tend to get it at very reasonable rates and terms. In fact, the SBA's underwriting criteria tends to be a lot more liberal than many banks. For instance, the SBA will allow a 10-year repayment period for a business acquisition loan. Many banks will lay their underwriting standards on top of the SBA and may say you only have a 7-year to repay that loan. Now that has significant implications. One is it affects your cash flow because you now have a higher monthly payment. Another difference is that the SBA says that a person can buy a business with as little as 10% down. Most banks want 20% or 30% down. Now that 20 or 30% down can include a combination between your down payment and the seller giving you a loan. Most banks will require the seller to provide you, the buyer, a loan because if the loan ever has problems, the bank doesn't know how to solve that problem. They need you, the seller, to step in to solve the problem, and they want you to have an incentive to do so. When you borrow money to finance a business, the bank will require anybody who has more than 20% ownership to provide a personal guarantee. The way that process works is the bank will lend to the entity, whether it's a corporation, S-corp, partnership, whatever. Then you as the owner will then stand behind it with a personal guarantee. Even if your spouse does not have ownership in that business, some banks may require them to also provide that personal guarantee because they want to ensure that you don't hide assets in the spouse's name. If you have more than 25% equity in your personal residence, SBA rules require them to take a lien on your residence or put a mortgage on your residence. Some banks, even if you have less than 25% equity, will still put a mortgage on your personal residence. Now, there may not be very much equity there, but it's what they call psychological equity, which means that if there's a problem, because you know there's a lien on your personal residence, you're going to answer the banker's call. If you're married, the law requires that your spouse approve that mortgage on the personal residence, and you need to know that up front and early in the process.